Subscribe to LearnCab and hit the bell icon to get notified.
In the earlier episode, we were discussing about the temporary difference. We now know that there are two types of temporary difference: taxable temporary difference and deductible temporary difference. The discussion that we are going to do in this particular episode, consider it to be an extension of what we have already discussed in the earlier episode. See, in the earlier episode, we argued that if you are having taxable temporary difference, then it will result into higher taxable profits in future. In other words, you will end up paying higher amount of tax in future, and hence you should recognize a deferred tax liability. As opposite to this, we are having a deductible temporary difference. Deductible temporary difference is a difference which will result into lower taxable profits in future. In other words, you will end up saving tax in future. And because you are going to save tax in future, savings and tax is nothing but a future economic benefit. And that is the reason we are recognizing a deferred tax asset. But the moment you say that you are planning to recognize an asset in your books, our accounting standards become slightly conservative. See, when you have to recognize a liability, no problem. But the moment you say I want to recognize an asset, there will be certain checks and balances. This is nothing but the principle of prudence. And following the principle of prudence, certain conditions have been set. Certain criteria are given in Ind AS 12 for the purpose of recognition of deferred tax asset. If you see our write-up also with respect to the treatment of temporary difference, if you check for the deductible temporary difference, right? If you just check for that, you will realize that we are suggesting at the end, right? We are suggesting at the end that you should recognize deferred tax asset. We are saying recognize deferred tax asset, but if you read it carefully, it says subject to fulfillment of certain conditions. In the earlier episode, we discussed at a great length that when can we recognize a deferred tax asset? What exactly is the nature of a deductible temporary difference? But now that we know that there is a deductible temporary difference, we know that we can save tax in future, we know that we are planning to recognize an asset. Since you are planning to recognize an asset, Ind AS 12 is now giving us certain criteria. You fulfill those criteria, or you may even call it as conditions. I have no problem with that. You fulfill those conditions, only then you can recognize a deferred tax asset. There are basically three criteria. I am calling it as three-step criteria. Why three-step? Because you have to follow them in a chronological order. Chronological order means you have to first follow the first step, then the second step, and after that the third step. So three steps are there for the purpose of recognition of a deferred tax asset. Let's take some figures and it will become really clear that what exactly are we suggesting by a three-step criteria. Let us say you are having a deductible temporary difference. Let's put it in this way. You have a deductible temporary difference. Let's say the deductible temporary difference is rupees 40,000. Okay. Let us say the tax rate is 30%. Okay. So you are having a deductible temporary difference of 40,000. The tax rate is 30%. So what you are planning is that 40,000 I'll multiply by 30%. So I'll get 12,000, right? You are planning to recognize a deferred tax asset of 12,000. But you just cannot go ahead and recognize this DTA. There are certain criteria that have to be fulfilled. Let's try to understand this. You are saying, when you say DTA is 12,000, that means you are trying to say that in the next year or years, right? In future, basically. In future, you will save tax of 12,000. What is deductible temporary difference? Deductible temporary difference is a difference which will result into lower taxable profit in future. If you say lower taxable profit in future, that means I will save tax. So my calculations are showing that I can save tax of 12,000. But then there is a very simple thing. When can you save 12,000 rupees of tax? Only if you are going to pay tax in future, isn't it? If you are not going to pay any tax in future, then where is the question of saving it? So The first criteria which has been suggested in Ind AS 12 is that there should be sufficient taxable temporary difference. This is the first criteria that we have to follow. They are saying that you can recognize DTA to the extent of sufficient taxable temporary difference. Why taxable temporary difference? Because taxable temporary difference is a difference which will result into higher taxable profits in future. Now, when there will be higher taxable profit in future, I'll have to pay higher amount of tax. And when I will have to pay higher amount of tax, with the help of deductible temporary difference, I will save that much of tax. And that is how my DTA, which is an asset, will get realized. You get my point? So let us say there is a taxable temporary difference. Let's say there is a taxable temporary difference of 60,000 rupees. Okay. Let us say there is some item of depreciation because of which there is a taxable temporary difference of 60,000. What is the concept of taxable temporary difference? My taxable profit in future will increase. And because the taxable profit will increase, I will end up paying higher amount of tax. I am expecting that in future I will have to pay 18,000 rupees of tax. So what does that mean? Against that 18,000, with the help of deductible temporary difference, I will save 12,000. So my deferred tax asset will get realized. I should go ahead and recognize the deferred tax asset. So the first criteria is, or the first step is, recognize deferred tax asset to the extent of sufficient availability of taxable temporary difference. So if I have sufficient taxable temporary difference, it will result into higher taxable profits in future. I will have to pay higher tax in future, but I will save that higher tax with the help of my deductible temporary difference. And that is how my asset will, by asset I mean deferred tax asset, that is how my deferred tax asset will be realized in future. I will go ahead and recognize the DTA. Comfortable? So recognize deferred tax asset to the extent of availability of sufficient taxable temporary difference. That is what we are suggesting over here. In our example, we have sufficient taxable temporary difference. We will go ahead and recognize a deferred tax asset. Right? But let us take an alternate view now. Let's take an alternate view. Let us say instead of 60,000, I do have taxable temporary difference. Okay, I do have taxable temporary difference, but I have taxable temporary difference of only 10,000. So 10,000 into 30%, that is turning out to be 3,000 over here. I can recognize DTA to the extent of availability of sufficient taxable temporary difference. I do have, but only 10,000. What does that mean? This means there will be higher taxable profit in future, but of 10,000 rupees, on which I'll have to pay 3,000. DTA is suggesting that I will save tax of 12,000 in future. But if you have to pay only tax of 3,000, then how will you save tax of 12,000? I hope you get my point, right? So what has happened is you have a taxable temporary difference. It will result into higher taxable profit of 10,000 in future. In future, I will have to pay 3,000 of tax, but my deductible temporary difference is suggesting that I can save tax of 12,000. But if I have to pay 3,000, how will I save 12,000? So DTA will be recognized over here. I'm not saying DTA will not be recognized, but DTA will be recognized only to the extent of availability of taxable temporary difference. We know that 3,000 of tax can be saved. So I will recognize DTA of 3,000, but DTA of 9,000 will remain unrecognized. As you can see, you are planning to recognize a DTA of 12,000. 3,000 will be recognized by me. Okay, 3,000 will be recognized by me. But my deductible temporary difference is making me eligible to recognize a DTA of 12,000. 3,000 I have recognized. So what about the remaining 9,000? Remaining 9,000 will remain unrecognized. I do not have sufficient taxable temporary difference to recognize the remaining portion of DTA. So that is the first step. Is there sufficient availability of taxable temporary difference? Yes, to that extent, go ahead and recognize a deferred tax asset. But let us say the taxable temporary difference is not there or is not sufficient. Okay. As I said, this was the first step or the first criteria. In chronological order, now you will go for the second criteria. Okay. So let's understand now the second criteria. As we realize at the end that 3,000 rupees of DTA has been recognized by us, but 9,000 of DTA is still unrecognized. What is the second step? Simple. Ask yourself, in the next assessment year or years, will there be sufficient taxable profit? Okay. Earlier we were saying, will there be sufficient taxable temporary difference? Okay, that we have already done. Now ask yourself, will there be sufficient taxable profit in future? So what if there is sufficient taxable profit in future? What will happen? If in the next assessment year there is sufficient taxable profit, I will have to pay tax, and at the time I will save tax thanks to the deferred tax asset. You get my point? So that is the second criteria that we have to now follow. Second criteria, you should ask yourself, is sufficient taxable income probable in future, right? Is it probable in future? See, this calculation of deferred tax asset is done at the end of the year, right? So at the end of the year, you should ask yourself that in the next assessment year or years, will there be sufficient taxable income? Ind AS 12 uses the word probable. By probable, we mean more than 50% chance, right? Your probability should be more than 50%. You should be basically more than 50% sure, right? Most of the entities will be more than 50% sure. See, if you are having sufficient profit every year, if you are earning sufficient profit every year, then obviously there will be taxable income in current year. You are also expecting taxable income even in the future. Okay, so that is the reason you will have sufficient taxable income. Because of taxable income, you'll have to pay tax. And at the time of paying that tax, thanks to the deductible temporary difference, I will save tax. And hence, to that extent, I can recognize my deferred tax asset. Okay, only thing is, as I have told you, you have to be more than 50% sure that there shall be sufficient taxable income in future. But let's take another possibility. It is quite possible that you are having taxation loss in the current assessment year. So there is a recent history of taxation loss. Now we know that taxation loss can be carried forward, right? Income Tax Act is allowing taxation loss to be carried forward, unabsorbed depreciation to be carried forward. Now, as you will carry it forward, in the next assessment year, you will adjust that taxation loss. You will set off that taxation loss against the taxable income in future. And it is quite possible that after the set off, there is not taxable income. There is no taxable income present. So if you are having a history of recent taxation losses, then be careful. Ind AS 12 says that, see, if you have a recent history of taxation loss, then you should have convincing evidence that there shall be sufficient taxable income in future. Okay, they changed the words. They say that you should have convincing evidence. This is what they say. You should have convincing evidence. Convincing evidence, you should understand convincing evidence as you should be now 100% sure. Earlier we were saying you should be more than 50% sure. Now they are saying you should be 100% sure. Again, I am repeating it. When you are recognizing the deferred tax asset, we are first checking for sufficient taxable temporary difference. Let us say that taxable temporary difference is insufficient. Now we will ask a simple question to us that in the next assessment year, will there be taxable profit? Okay. If you say yes, if you are more than 50% sure that yes, there will be sufficient taxable profit, please go ahead and recognize the deferred tax asset. But then Ind AS 12 says that please be careful. If you are having taxation loss in the current year or maybe in the previous year, the words used are that if you have a recent history of taxation loss, you can recognize DTA provided you are 100% sure that there shall be taxable profit in future. You should never forget this one thing, that the concept of DTA is that you will save tax in future. But you can save tax in future only if you are going to pay tax in future in the first place. I hope you get my point. If I have taxation loss in the current year and I will carry forward the taxation loss in the next year, and then I will set it off against the next year's taxable income, and again there will be no taxable profit. If there will be no taxable profit, I don't have to pay tax. And if I don't have to pay tax, where is the question of saving the tax, right? You can save tax only if there is going to be taxable income. That is the reason Ind AS 12 says is that, see, if it is a regular years means my business is doing well. Every year I have taxable profit. So current year also I have taxable profit. And I'm more than 50% sure that yes, there will be taxable profit even in the next year. Then go ahead and recognize the DTA. But if there is taxation loss, then I may not be 100% sure that there will be taxable income. If I am not 100% sure that there will be taxable profit in future, I should not recognize the DTA. Comfortable? So let us say, applying this particular criteria, let's assume for a moment that there is no taxation losses and all. Right, let us put it in this way, that there is no taxation loss and all. There is sufficient taxable income in future, let us say, right? I'm expecting a taxable profit. In the next year, I'm expecting taxable profit. I'm expecting taxable profit of 20,000. This I multiply with the tax rate 30%. That means I will have to pay tax of 6,000. But because I have, your eyes should be now on this, okay? But because I have a deductible temporary difference, I can save tax. So what will happen is, I'm expecting a taxable profit of 20,000 in future. I know that in the next assessment year, I will have to pay 6,000 rupees of tax, but thanks to a deductible temporary difference, I will not have to pay that tax. So to the extent of 6,000, I shall recognize a DTA. So 9,000 was unrecognized in the earlier. I strike that thing out now. Earlier 9,000 was unrecognized, but here what I'll do is I'll recognize 6,000. Right, 6,000 of DTA is recognized now. I recognize the DTA. So earlier it was 9,000. 6,000 is now recognized by me, right? I have recognized it. So I'm still left with 3,000. Okay, I'm still left with 3,000. This 3,000 is now unrecognized. Getting it? So applying the second step, I'm able to further recognize the deferred tax asset of 6,000. I'm expecting taxable income in future. I know I will pay tax in future, but I also know that there is a deductible temporary difference. Thanks to it, I will save tax. And that's the reason I will recognize further DTA. So our original plan was to recognize the DTA of 12,000. As you can see, out of that now, 9,000 worth of DTA has been recognized. Now that you have applied the second step, and if you are still having unrecognized DTA, then we will apply the third and the final step. As I said, chronological order, right? Now we look at the third and the final step for recognizing the DTA. Third step, what exactly is it? The third step is, are there any tax planning opportunities available? Right, is there any tax planning opportunity available? And based on that, I may recognize the DTA. Okay. Do not get carried away by this term tax planning. Okay. Normally we understand tax planning as ways by which we can legitimately reduce our taxation. Right. When you say I want to do tax planning, you know, when some client approaches us and says that I want to do tax planning, by tax planning we mean that how can I reduce my tax? Here we are talking about tax planning by which you can increase your taxable income. See, you are planning to recognize the DTA. When can you recognize DTA? Only if you have to pay tax in future. So you are asking yourself that is there any way by which I will pay more tax in future so that I can recognize the remaining portion of DTA? So a very different, right? We are looking at tax planning in a very different context over here. Ind AS 12 is suggesting that now the entity should identify, are there any tax planning opportunities available which will result into higher taxable income in future? And because you have higher taxable income or taxable profit in future, you will have to pay tax. And because you have to pay tax, thanks to the deductible temporary difference, you will save that tax. And hence you should recognize a DTA. Okay. For example, let us say you're having some valuable asset. You can sell that particular asset and it can result into short-term capital gains for you. Let's say if it is a business asset, we know that when a business asset is sold, there will be short-term capital gain. So I have a valuable asset which I'm using in my business. I sell it. Just think for a moment. I sell it. Then there will be sufficient short-term capital gains. Short-term capital gains we know will be taxed at the regular tax rate. And thanks to that, I may have to pay tax, and because I have a deductible temporary difference, I will save that tax. Or there might be certain deductions which I defer. For example, I am eligible for certain deductions in the current assessment year, but I defer those deductions. I am of the view that I don't want to claim that deduction. If I do not claim those deductions, then there shall be higher taxable profit. Higher taxable profit, I'll have to pay more amount of tax. But because of deductible temporary difference, I will save that tax. Okay, so think about genuine ways by which you can increase your taxable income in future. If you can increase your taxable income in future, to that extent, you can recognize a deferred tax asset. So let's think for a moment. Let's think for a moment that a tax planning opportunity is available to us. Okay, a tax planning opportunity is available to us by which we are expecting that our taxable profit will increase by 6,000 rupees, let's say. So 6,000 into 30%, I am getting 1,800. So because of this, I'll have to pay 1,800 rupees of tax. As you can see here, 3,000 is still unrecognized. Out of 3,000, I will recognize now 1,800. So I'm still left with 1,200. 1,200 will remain unrecognized. Okay, it will remain unrecognized. Yes, in the next assessment year, when better opportunities are available, you may then recognize this unrecognized portion of DTA. I'm not saying that 1,200 will remain unrecognized permanently. For example, in the next year, by year I mean assessment year, in the next assessment year, there is a higher amount of taxable temporary difference available. Then whatever is the unrecognized DTA, that can be recognized by me. Okay, or there may be more than sufficient taxable income available. Then also I can recognize the unrecognized portion of DTA. So every year the entity should review that whether the portion of DTA which remained unrecognized in the previous year, can it be recognized in the current year or not. However, as far as the current year is considered, 1,200 will remain unrecognized. Let me tinker the figures a little bit. Instead of 6,000, let's say you have a tax planning opportunity of increasing your profit by 60,000. That means I will end up paying additional tax of 18,000. Then this entire 3,000, okay, then this entire 3,000 will get recognized. This entire 3,000 will get recognized by us. Because you have to now pay tax of 18,000 and I can save tax of 3,000 rupees due to the deductible temporary difference. This time the DTA is fully recognized. So if you are having a deductible temporary difference, right, let's very quickly summarize it. If you are having a deductible temporary difference, it will result into lower taxable profit in future and hence you will save tax. You are planning to recognize an asset. Ind AS 12 is putting certain criteria for recognizing that asset. Okay, you will recognize the deferred tax asset provided you are following the three-step criteria. And remember to follow these three-step criteria in a chronological order. The first criteria or the first step is, do you have sufficient taxable temporary difference? If yes, recognize DTA. Okay. So it says recognize DTA to the extent of availability of sufficient taxable temporary difference. Okay. After applying this criteria, if there is still any unrecognized portion of DTA, then go for criteria 2. Criteria 2, you are saying that I will save tax. So if you have sufficient taxable income in future, you will have to pay tax on it, and that tax can be saved through the deductible temporary difference. So that's the second criteria. Recognize DTA to the extent it is probable that there shall be sufficient taxable profits in future. By probable, we mean more than 50% chance, okay, or more than 50% sure. You are more than 50% sure that there will be sufficient taxable income in future. Please go ahead and recognize the DTA. But if you are having taxation loss in the current year, or you have a recent history of taxation loss, or any unutilized tax credits, then you can recognize DTA provided you have convincing evidence that there shall be taxable profit in future. Convincing evidence. Now you should be more than, you cannot be more than 100%. Now you should be 100% sure, right? However, if the entity has history of recent taxation losses, then entity recognize DTA on unused tax losses or unused tax credits only if the entity has convincing evidence that there shall be convincing evidence. Yes, do not forget it, 100% sure that there shall be sufficient taxable profits in future against which such unused tax losses or tax credits can be utilized by the entity. Okay. So what will happen is you will have sufficient taxable income in future. I will set off my taxation loss, which I am carrying forward. And after that set off, there is now again taxable income. And because there is taxable income, now because of that deductible temporary difference, I can save tax. So you can now recognize the DTA. If there is still unrecognized DTA, okay, then go for the final criteria, criteria 3. Do you have any tax planning opportunities? Okay. Recognize DTA to the extent the entity has tax planning opportunities through which entity can create sufficient taxable profits in future against which the deductible temporary difference can be utilized. So do you have ways and manners by which you can increase your taxable income in future? If you are saying yes, then you can again recognize the DTA. Okay. It's quite possible that after applying all the 3 criteria, in spite of that, you may still have some unrecognized portion of DTA. Yes, it is possible. We are reading the note now. It is possible that even after applying all the above 3 criteria, DTA may remain fully or partially unrecognized. So what should you do? At the end of each reporting period, entity should reassess unrecognized DTA and recognize them subsequently as and when any of the above criteria are getting fulfilled. In the current year, I have deductible temporary difference, but I do not have sufficient taxable difference. I am not sure about future taxable income. I do not even have taxation, tax planning opportunities. So I will not recognize the DTA. Next year, again, I will ask myself, do I have sufficient taxable temporary difference? If your answer is yes, then the DTA which remained unrecognized in the previous year can be now recognized in the current year. So whenever any of these 3 steps are getting fulfilled in that particular year, by year I mean the assessment year, in that particular assessment year, I will recognize the DTA. Of course, recognizing a DTA in an assessment year means you are recognizing DTA at the end of the current previous year.
Subscribe to LearnCab and hit the bell icon to get notified.